Hey everybody, Smart Silver Stacker here. And as you're probably already aware, assets across the board have been selling off for the past several trading sessions. We've got the S&P 500 and the Dow both now officially in correction territory. The Nasdaq's even worse, it's officially in a bear market. Bitcoin briefly traded below $30,000 and now it's down by more than half from its high of last year. And gold and silver have not been exempt from the selling pressure either, but I do view the recent drop in both precious metals as a buying opportunity. And in today's video, we're going to be going over 3 indicators that show just how undervalued gold and specifically silver are to other assets. And we'll also be going over some silver and gold price predictions based on those indicators. So let's get to it. Okay, and we're just going to get right into it here. The first indicator we're going to be looking at is precious metals relative to stocks. And what you're looking at right now is the Dow to silver ratio. This is the 100-year historical chart. And the way that you arrive at this ratio is you take the price of the Dow, so right now that's around 31,834, and then you divide it by the price of silver, which right now is about 2156. And so you can see the Dow to silver ratio right now is about 1,476. In 2011, the ratio got as low as 328. And then in the really big bull market that we had in silver back in 1980, the ratio got down as low as 2389. Now, I know that people are just going to say, oh, that's the Hunt brother manipulation. So we're just going to look at the ratio that we got in the last big bull market back in 2011. We'll say about 302. And so the current price of the Dow is about 31,834. Divide that by 302. And that would give you a silver price of about $105 to get back to the same ratio that we had in 2011, assuming that the Dow maintains its current price level. And of course, you could get to that lower ratio by either decreasing the price of the Dow or increasing the price of silver. But if you were to say that the stock market just stays right where it is today, to get to the old ratio, you would need about $105 silver. And then, of course, to get to the 1980 number, you would need a much, much higher price of silver. And I know we're just going to hear about the Hunt brothers, but we'll go ahead and run that math. The old ratio, about 2389. And you can see that in order to hit the ratio that we had back in 1980, if stocks were to stay where they are today, we would need to see a silver price of about $1,332. You know, that may seem crazy. That may seem like a very high price target. But if you look at the relationship between silver and the Dow that we had back in 1980, that's the price of silver you would need to get to. And it's important to note that in 1980, it was primarily silver rising in price that compressed that ratio. It wasn't a huge correction in the stock market. Now, I know everybody's just going to talk about the Hunt brothers and how 1980 is not a valid example, but the Hunt brothers weren't manipulating the price of gold. And this is a chart of the Dow to gold ratio. So we can take a look at that and we can see that, gold had a huge run up in 1980 as well. And that was on, the inflation fears of the early 80s. Paul Volcker had just cranked up interest rates, and you can see high interest rates aren't always bad for gold because that triggered one of the biggest bull runs in gold's history. And this ratio got as low as 1.38. Actually, I think it got a little lower than that. Let's see. Yeah, 1.3 in February 1980. That was as low as the ratio got. So again, taking the current price of the Dow, if you were to divide that by that ratio, you would need a gold price of $24,487 if the Dow were to maintain its current price level. So if we were to see a major bull run in gold and the ratio compressed to the level that we saw in 1980 of gold relative to stocks, you would need a gold price of about $25,000 or so. And then the next chart I want to take a look at, this is the real estate to gold ratio, a 70-year chart of that. And one thing you'll notice, basically what this is, it's a measure of how many ounces of gold it would take to buy an average house in the US. And the way they arrive at this is they divide the Case-Shiller Home Price Index by the price of gold. And one thing that you'll notice here is that this chart is not at the high end. Right now we are at a ratio of about 280, roughly 280, 279.59. So we'll call it 280. You can see in the past, like in the 70s, it cost over 1,000 ounces of gold to buy your average house. Now, one way to interpret that is that possibly, gold has protected purchasing power better than homes, and so now homes are a lot cheaper relative to gold than they were before we came off the gold standard. But then again, you do also have to consider things like rents, because gold doesn't have any yield, and houses you can charge rent or you can live in them, so you get some benefit from them. But the thing I really want to draw your attention to here is that we are still, even though we're not at the high end of the chart, we're still much higher than the lows. And if we're about 280, if you look back to 2011, last time gold had a nice bull run, the ratio got down to about 139, so half of where we are now. So if we get a bull run in gold and we revisit those lows of the ratio, and in 1980, same story, a bull run in gold and the ratio got down as low as 116, you could certainly buy more housing for your gold than you can today. And then really a much more compelling chart than this one, I think, is this one, the silver to oil ratio. This chart, you'll notice, has a very remarkable pattern here where it very predictably kind of moves up and down within this range. And that makes a lot of sense because, as inflation and other factors have driven up the prices of commodities, or, other factors have driven them down, recession and the like, you kind of would expect commodities like silver and gold to kind of trade not necessarily in tandem, because what we see is some assets react more quickly than others to certain factors. And so silver might move up faster than oil, but then oil will catch up. And then when oil drops, maybe silver lags the drop a little bit. And that's why you see these peaks and valleys here on this chart. One thing that you'll notice is right now we are at the low end of the chart. And what this ratio represents, this is the silver to oil ratio. So this is basically how many barrels of oil you can buy for 1 ounce of silver. And right now, we are down at around 0.22. So right now you can buy for 1 ounce of silver 22% of a barrel of oil. And you'll notice that the high end of this chart, we won't use the 1980 number, which is actually the only time that an ounce of silver became more expensive than a barrel of oil. So you get 1.10 barrels of oil for your ounce of silver. But I know, again, the Hunt brothers and manipulation and all that, so we'll exclude that data point. But you can see there have been a couple times when we've gotten up as high as 0.8, where you've been able to buy 0.8 barrels of oil for your ounce of silver. And that's close to what we got back in 2020 when the price of oil fell so much. I mean, silver too was tanking, but oil fell much faster than the price of silver. So if you want to figure out, based on today's price of oil, which is about $105, and it's important to note, I think, that we've seen all this sell-off in stocks lately and assets across the board, but oil today was up almost 6%. So I think that commodities may be showing a little bit of strength, even though we're still seeing sell-offs amongst equities. But, I'm just digressing. So back to the topic here. If we were to take the current price of oil and say we were to move to the high end of this chart of 0.8, we would need a silver price of about $84. There are two ways, of course, that the ratio could move higher. The price of oil could drop, or the price of silver could move up. But again, today we're seeing strength in oil. I don't really think that with the current geopolitical climate, there's much likelihood of oil dropping too far. We've still got the conflict over in Eastern Europe, and one of the players there, Russia, they are the world's biggest exporter of crude oil, and now we're seeing embargoes against their oil. So we may be seeing a big chunk of world oil production cut off from Western markets. So again, I don't really think the price of oil is going to be falling, although there's plenty of signs to indicate that gold and silver may be moving much higher soon. And also we can take a look at this gold to oil ratio chart. And we can see that this chart got extremely high back in 2020 when we saw that big drop in oil, up to almost the 80 level, where you could get 80 barrels of oil for 1 ounce of gold, or close to that number, although it's dropped way back down here to 18.26 barrels of oil for your ounce of gold. And, this does look kind of like an outlier here, this spike up to 80. And although I wouldn't be surprised if we see another spike up like this as the price of gold moves much higher, aside from that one outlier data point, you can see the high end is sort of in the mid 30s for this ratio. We've got a couple of spikes up to around the 33 range. So even if we were to just use that number, if we were to take the current price of oil, about $105, and we were to multiply that by the high end of this chart, excluding that outlier high data point, you would need a gold price of about $3,465 just for like kind of the normal high end of this chart. Unless, again, you could also see the price of oil fall to make this ratio rise, but it doesn't seem like there's much likelihood of that given everything that is going on in the world at the moment. And then finally, so we've looked at the price of stocks relative to precious metals, the price of real estate relative to precious metals, the price of oil relative to precious metals. Finally, we're just going to look at, this is sort of your bonus indicator. This is the gold to silver ratio chart over 110 years. So thank you to longtermtrends.net for that. I know that this doesn't really show that precious metals are cheap relative to other assets because you're just comparing precious metals to other precious metals. But there is something to be gleaned from this chart, and that is that we are still at the high end, and that tends to be something that happens when gold and silver are undervalued. You can see that the biggest spike up we have on this chart also is from 2020, where the ratio got to about 110, and that means that to buy 1 ounce of gold, you would need 110 ounces of silver. And that was a screaming indicator that metals had become oversold and were really cheap. And we did see a really strong rally after that, but it never really got down to what you see in bull markets. If we look at the 1980 bull market, you can see the ratio compressed as low as 17.32. So for every 17 ounces of silver you had, you could buy an ounce of gold. And then also in 2011, the ratio got significantly lower than it is today, down to the 39 level. So right now, after the sell-off we've had after the past couple days in gold and silver, the ratio is about 83-33. And again, seeing the metals fall, you see this ratio move higher like we have in recent days. And then as you see a bull market develop, you tend to see the ratio move lower. So right now, we are about twice the level that we were at in the 2011 bull market. So I think it is an indicator also that gold and silver are on the cheap side. That is why I see the recent fall in gold and silver as a buying opportunity, and I think that they are very cheap relative to other assets. And with everything that's going on, with the dollar being printed into oblivion, we are seeing assets like stocks falling, Bitcoin falling drastically on a very small increase in the federal funds rate. We have sovereign governments are loaded up to their eyeballs with debt. Consumers are up to their eyeballs in debt. I really don't think it's going to take much more to push this economy over the brink. And that's when we're going to see the Fed kind of capitulate, reverse policy, open the floodgates of liquidity again. And I suspect that that will be the time that we see gold and silver move up in a big way. And maybe we will hit some of those price targets. I mean, clearly the charts and the data that we looked at today, I think they show that around $100 is sort of the base case for silver. And then gold, about $3,500, $3,000, that's sort of the low end of the price predictions for gold, my price predictions for gold. And none of this is investment advice, everybody. I am just a guy on YouTube, of course, so do your own due diligence. Don't go out and invest your money based on what I'm saying, but take a look at the data and, use that to inform your decision making. That's all I'm going to say there. And if you enjoyed this video and you got some value from it, please do give it a big thumbs up. And if you haven't subscribed yet, consider subscribing to the channel. I really appreciate all of you who have been watching for a while and who are subscribed to the channel, and I will catch you next time. Thanks again for watching. Smart Silver Stacker, out.